All right. Well, good afternoon to our friends here on the East Coast, and good morning to the rest of the country. Welcome, everyone, and thank you for joining Rescue, Refinance, or Reimagine. And today we're going to talk about premium finance and versions of premium finance, even some of the collateralized whole life that we've looked at very closely in the last several months in a higher than normal interest rate environment. So my name's Anthony Mento, and I'll be moderating today's conversation with really three all-stars, and we kind of handpicked this crew. Justin Smith, Chris Daniels, and Chuck Perrault. Justin and Chris manage their respective practices, both, in my opinion, the foremost authorities on premium finance and advanced markets. Chuck in the advanced market teams at Prudential. We'll talk about how he fits into this discussion and some unique strategies that Prudential employs when it comes to the peripheral of this marketplace. So while the rise in interest rates have created some headwinds, it's also created some clarity in this space. So, today what we're going to do is we're going to focus on what's working, where the opportunities lie, and how to reposition both old and new cases for long-term success. So, let's start with a quick pulse check before we dig into deeper strategies. Chuck, Chris, Justin, thanks for being with us.
Thanks for having us.
Thank you, Anthony.
So, I've carefully crafted a question set and consulted with the subject matter experts that whereby if I was a participant in this presentation, what would I want to know if I was in the space of premium finance or had a client base that maybe catered to this strategy? What would I want to know, good, bad, or indifferent? So, in the nature of starting on a positive note, I'm going to pose this question to Justin and then Chris. Justin, in one sentence, what's the most encouraging trend or opportunity you've seen in the premium finance space over the last 18 months?
Yeah, I think it comes down to pressure, right? Pressure often creates solutions, right, that are born out of it. Diamond comes from nothing but pressure. We're seeing that in from a collateral standpoint across the board, and banks have been forced more so than ever before to become much more flexible, dynamic, and creative, I would say, with how they're evaluating collateral, how they're designing collateral, what assets they're open to accept as collateral. And I think that is a trend that will benefit everyone long term. The more familiarity, the more struggle that we go through, it'll force change. And that's a bright spot that I'm seeing in the space that is producing some great results.
Nice. Chris, what's the most encouraging trend or opportunity you've seen in this space in the last 18 months?
Yeah, I'd agree with Justin's comments. I think for our firm, what we've seen a shift over the last 18 months is just openness and activity from clients. It's starting to feel like COVID level volume where we're getting a lot of at-bats. We have a lot of openness from clients and their advisors to solve problems that they've been hesitant to take care of and address in the past. And we're seeing action. So we're seeing people make decisions where it felt like 18, 24 months ago, there was a lot of indecision in the market. And as it relates to financing, and we're approaching new opportunities today, I know we're going to talk a bit about the in-force block that Justin and I manage and that we see in the industry, but I think clients feel really good evaluating this as a funding option with where interest rates are today. So, we're at the peak of a curve from 5 or 6 years ago. I think there's relative stability going forward, whether that means we may get an increase, it may hold or may drop 25 to 50 bips. I think they feel good going in and evaluating it at a 5 to 6% cost of capital today. It seems reasonable relative to history.
Thank you, Chris. So just real quick, the chat and the Q&A are open if anyone wants to type their questions. Today's session will be recorded. So you'll receive a copy of this recording by the end of the week. So in case you miss anything, we'll have it well documented. So Chris, we're going to stay with you here. Let's shift gears a little bit, but Chris, what does the current market for premium finance actually look like? And while you answer that, please address maybe just a couple subsets of, in addition to the market, where are you seeing new activity or growth, and what types of clients or profiles are still a fit?
Thank you, Anthony. Good question. What we have seen over the last couple of years, at least from a carrier perspective, and Chuck can touch on this, we've gradually seen carriers increase the net worth requirements for clients to participate in the space. We've always focused on that $25 million and up, but there was a time where you could do deals for $3 million, $5 million, $6 million clients. And those are a lot of the clients that are in trouble today. I think never had the balance sheet to be able to do this transaction. Where we're seeing opportunity today is still in that 25 million and up balance sheet. Oftentimes concentrated positions, either in an operating company, in real estate, in alternative investments, and forgetting about financing for a minute, how life insurance fits on the balance sheet and what the risk return profile of this asset class is against marketable securities or equities, bonds, private credit, private investments, and educating them first on how life insurance can perform unlevered, and then showing them the advantages of leverage, whether that's from a cash flow standpoint, or the ability to acquire more of it than they could in a self-financed market.
Well said. So Chris, as a follow-up, and Justin, we'll move to you next. What kind of product design, collateral requirements, or structure tweaks are helping the math work a little better today?
Yeah, so our firm, Anthony's, has always been, I'd say, product agnostic, though we have our favorites depending on, I think, the market, where we're getting underwriting. Today we're about 70% IUL, 30% whole life. Over the last few years, we've seen a little bit of a drag in the whole life market, a bit of an uptick in the IUL. More clients also, though, diversifying between the two in different percentages depending on age and long-term goal. But this ultimately comes down to collateral. So as we think about it as an asset allocation, we'll look at a client's balance sheet. Let's say it's 50 million bucks, and they have a position in the business, a position in real estate, some marketable securities and alternatives. We'll try to make a case for why life insurance should be a sleeve of that allocation, and then measure how much they should do based on available cash flow, or liquidity/collateral. And for us, when we're measuring a plan design for a client, this would be different than if an attorney is telling a client, you need to buy $20 million of life insurance. Why those are great for everybody on the panel, they also don't show up every day. So, proactively talking about the asset class and introducing how it fits on the balance sheet generates sales and opportunity, but then sizing it to collateral. So if we're doing a plan design, regardless of amount, we want to look out at collateral in 6 to 10 years. Forget about year one. That's the most inconsequential year of a transaction. When we look out in years 6 to 10 and we're measuring for a projected shortfall, we want to make sure that projected shortfall is less than 25% of available liquidity to a client. And that's how we manage through market cycles and interest rate movements like we saw over the last 3 to 5 years.
Yeah. That's an amazing practice. And, like the great Ray Dalio said, right? If you put some math and protocols in place, you don't have to make tough decisions every single day, right? So Chris, your experience brings you to ultimately coming down to collateral, right? Which is number one best practice. You've said it better than we've articulated in the past, because I'm always asking for a balance sheet. And right, it's not lead with premium finance because you're worth X amount of dollars, right? Those days are over. the question becomes, what type of collateral do we have to work with? And then we can back into the design. And looking out and putting that formulaic, taking that formulaic approach, 25% of liquid net worth 6 to 10 years out. Can we absorb the high point? And that really starts to shape the discussion and back you into like where we're starting. So great, terrific response. Justin, what does the current market look like? Where are you seeing new activity or growth? And what type of clients or profiles are still a good fit in your practice?
Yeah, I think Chris nailed so many of the high points there. Um, I'll tell you first, I think where I see the market not being anymore, and we're seeing a lot of the what we've referred to as speculative premium financing being flushed out of the market, and it's still present. Certainly, it's still being sold as a strategy. It's still being sold based on internal arbitrage between crediting rate and borrowing cost, with some pretty ambitious assumptions. So, I've always been of the opinion that the one thing missing from so many of these like really attractive spreadsheets that are present in the market is our assumptions around cap rates or dividends, right? From a dividends perspective on whole life, we've got a long way to go before these giant portfolios hit an inflection point and start moving upward. Similarly, we're in an environment where cap rates are still under a ton of pressure. Option costs are on the rise. They're highly volatile. The market's highly volatile. So there's still a long way to go on that. And so what I was hearing, Chris talk about are the folks who have the balance sheet. They have the wherewithal to understand that financing is a funding decision, and it's a dynamic decision, right? One that may be changed over time, but that going in and setting expectations right from the beginning is a critical factor in designing any sort of funding, no matter what you're doing, and how might we pivot in 5 or 10 or however many years downstream. So I think that anyone who's got a balance sheet over $25 million needs the kind of planning work that Chris was alluding to, and going in and just throwing the $20 million dart at them by saying, here's a $20 million solution is missing the mark, right? It's really missing the mark. I think having the patience and the discipline and the team that allows you to go deeper into the planning and talk about cash flows, talk about how the premium will be paid, how it will be financed, how the interest will be paid, what is the estate plan, what's the source of cash flow, is it inside of the trust, have you moved income producing assets out? That kind of planning work is certainly in our practice where we see tons of opportunity, and we're only seeing more and more opportunity as time goes on. The next 20 years are going to be a huge opportunity for premium finance done right.
Yeah, well said. So for clarification to the audience. So Chris and Justin are not necessarily retail producers. They are premium finance experts who will shepherd a case on a joint basis with our writing agents and hold themselves out to be with you for the duration of the strategy from initiation to exit. So just keep that in mind as we're speaking. A question came in from the audience, which I think is probably the most appropriate time to weave in the question to the subject matter experts. My next question was going to be, and Chris, we'll start with you. What's the most common age group and balance sheet profile where you're seeing deals get done? And then to kind of enhance that using the question from the audience, that it seems with current interest rates, using policy cash values as the exit strategy, having the death benefit drop, and then needing the time for it to grow back to where you were before the rollout has made the entry point seem to be much lower, where it used to work at age 60. Now it seems more like a 40 or 45-year-old. Can you comment around that question?
Sure. So a wide range, but I would suggest 90% of the transactions that our firm closes is in that 45 to like 62, 63 range. Once we get above mid 60s, while you can still make the economics work on a model, you really increase the risk profile of the transaction. You've got clients over borrowing at older years when insurance is the most expensive. And I think the gap between what it would cost to pay for coverage at 68 and what it would look like to finance, and then what has to go wrong in a financing environment to not be ahead of just paying out of pocket, narrows the range of clients that tends to suit. So, that 50 to 60 range for us is where we're seeing real planning getting done. To Justin's point, the planning, having real advisors, attorneys, accountants, family offices around this continues to give credibility to what we do versus 5 years ago, where this was being pitched as a product that this is something you need to own because you can borrow the money to do it at 2%.
Mhm.
It continues to give credibility to us, not just from how a model plays out, but how you actually onboard this asset, how you get money in the trust, what are your gifting concerns, and the ability to use pre-tax dollars in a loan to fund an insurance policy rather than trying to lend off your own balance sheet, or gift big dollars or lend big dollars to the trust.
Yeah.
Anthony, remind me your second question outside of the age group.
Second question is policy values being the exit strategy.
Yeah. So it all comes down to a client and the collective advisors around the client buy in to long-term spreads that are achievable with this asset class against cost of money. So we're not going into transactions under the assumption that we're going to have interest rates at 6 today and then down to 2% tomorrow. But when you look back over an extended period of time, and we have some analysis and data that goes back 40 years, you can show in the IUL world, the collared IUL product at a moving cap as it adjusted over time against cost of capital, showing a 2.7 to 3% benefit on the product side or the asset class versus the liability. And then depending on what you can drive from a spread perspective, that gets better or worse. So clients that can borrow at SOFR plus 100 versus clients that are borrowing at SOFR plus 220, that gap or that opportunity narrows. The challenge is if you don't buy into the ability for the asset class to long-term outperform cost of money, the funding of the interest to keep the liability down will pretty quickly get more expensive than just buying insurance. So it's the combination of the education, how this asset class has moved against cost of capital, some forward-looking data or valuations that we're seeing. And ultimately for us, it's can we get back to a model that's 50 to 70% of what history has been from a spread perspective, long-term, to show the ability to crawl out of a loan through cash value. And then,
so you don't like the idea of financing a $50 million policy on a professional athlete where 100% of their balance sheet is sitting in fixed income?
No.
Are you telling me you don't like that deal? Oh.
Yes.
All right, thanks.
But I think that also does bring up a point when we talk about exit strategies. Every client's got to have a couple ways out of this. And nobody on this panel, nor in the audience, I think can make a fair estimate of the long-term spread. So if we do realize long-term spread of 2 to 2.5%, which is still historically conservative, you can make a case that you're better never rolling out of the plan and letting the spread or the value accrete in the life insurance policy against the debt. But if we don't realize that, you better have some levers to pull, whether that's through cash value access, and then how are you accessing it? Because if you're accessing it through participating loans, you may be taking more risk with the carrier than you are with the bank. Or do you have some dollars on the sidelines that you've allocated to be able to get out of this? And do you have a plan in place to get those dollars in trust to do so?
Well said. Chuck, I know you heard policy values as exit and you're frothing at the mouth, but we're going to get to you in a minute. Um, Along those lines, and Justin, this one's for you. Um, what are the keys to closing deals in today's higher rate environment? Are advisors leading conversations differently? And what are the very best top tier advisors do that others might miss?
Yeah, I think that's a really important factor in all this. So if you the market's evolved. Anyone who's listening to Chris's comments in the last few minutes, should recognize the level of complexity that of the analysis and broad base that analysis is to get to the right result. So I think the number one element of success is treating our advisors who treat their business like a law firm, right? That they are a specialist, but when it comes into a certain set of topics, they bring in other specialists for that part of the law. And in this example, I know this is, sounds gratuitous, but I think the success of many of these platforms is dependent upon the ability to look, look to your right, look to your left, and see if you've got specialists that are kind of still in the game, helping you manage, helping clients manage through these kind of economic turbulent times. So that's number one. Second piece associated with that, I think that the best partners that are helping advisors be successful in this are those that assist in setting expectations at an appropriate level. Everything Chris just talked about and has talked about, and certainly I think my comments allude to, is this all comes down to expectation setting. And you can only really set appropriate expectations when you pause and take the moment to build symmetry of information, right? And sell an insurance portfolio, place an insurance portfolio based upon symmetry of information, so that the clients and their advisors by the end of a process are as educated as everyone else that's part of the advisory team. That symmetry speaks to, again, go back to Chris's comment, downstream 5, 6, 8, 10 years having enough liquidity to manage through one of these storms. That comes down to expectation setting on the front end, creating and demonstrating a range of possible outcomes. So under what circumstances might my collateral be 50% higher than projected, and in what situations might it be 50% lower, and how probable are those outcomes, and am I prepared, if I'm the client, to weather those storms? That's in-depth analysis that needs to be created again, so it can set those expectations, and then setting the additional expectation of ongoing management. There are a bunch of known knowns, there are a lot of known unknowns, but the unknown unknowns that we can't see, we can do our best to predict them out of the gates. We can talk about what they might be, and have a much better picture than what we're seeing, I think, in this environment, which is the mad scramble. No one talked about these possibilities when they put it in place. I can't tell you how many customers that I've talked to of other people who brought their in-force financing, who said, I never knew that I had this much exposure. I did not know that I had my borrowing risk and then also the leverage inside of the policy of multipliers, et cetera, right? And I think with financing, like any other asset class, you want to focus on the economics, you want to manage it well, and then you want to constantly be de-risking whatever you can. And that's a de-risk in the policy, and that's de-risking the loan structure, and evaluating that at every possible turn. And I think, again, when you think about it from a law firm standpoint, having team members that are totally focused on these risks and stepping in to de-risk in the middle of a loan term example, or I should say, is a great example of how to end up in a good place, right? So 2020 came and the market fell to the floor, the yield curve flattened, it went exceptionally low. At that point in time, we were talking about our rates going to go negative. I mean, that was 5 years ago. Just 5 years ago, we were concerned about negative rate environment. Our firm was very proactive in reaching out to customers and saying, now's the time to put a hedge in place, put a swap, put a cap in place, and set yourself up for success. So today we have several customers paying far below market rate because, again, education, de-risking, kind of that role of risk manager on an ongoing basis. So that's, I know, a long-winded answer, but I think the advisors that are approaching it best are saying, hey, I've got a team of people that we're going to bring in to focus on your entire planning strategy, whether that's business succession or estate planning, to build the right program and to help manage it for the long haul.
Well said. So Chris, I'm going to piggyback off of that, right? And where we lobbed over to Justin, what do top tier advisors do that others miss, and our advisors leading conversations differently? One of the questions that I tasked you with, and full transparency to the audience, I gave Chris maybe 48 hours to prep on this one, but it's a question that we get all the time, right? And Justin alluded to it a bit ago, but just to bring it full circle, like one of the tougher client questions is, if I'm borrowing now in the 6-7% environment, and that's the same exact rate the policy credits, where's the upside, right? If you bring this to a family office or a CPA or someone who is not that familiar, right, or on the peripheral of financing, right, can borrowing at the same rate as we're achieving policy credits still create sustainable arbitrage?
Yeah, good. Another good question, Andy. So, I'll go back to some of my comments before. If clients are evaluating this transaction on a short-term basis, and they're looking at it 1 to 2 years out, then there's not a lot of incentive to go into. When you look back historically, either tied to index products or whole life, there has always been spread over different decades, and again, on average, in that 2.5% to 3% range. So doing the math and looking back at history and where we think the dividend may go, and even if caps hold today, there's certainly opportunity. If you're looking at it on a 1, 2, 3-year basis, without buy-in that we're going to receive future spread, it gets a lot less compelling. But once you go into the transaction, a big part of it is, what is the ongoing management? Again, we're focused on, like, where are we in 2025? But clients that are doing these strategies, even if the debt's going to be rolled out in 12 to 15 years, the assets meant to work over a 30, 40, 50-year period. And we need to manage towards that. And that's the value you get in working with a firm like ours or like Justin's. There is an ability for most of the participants on the call to be able to execute on and do a transaction. Like, you can go direct to many, if not all, of the institutions that we work with. I think getting the capital is one of the lower parts on the value tier of what we bring to an engagement. But what are you going to do over the next 3, 5, 10, 15 years? How are you going to manage the reallocation or the allocation of the life insurance policy? How are you going to deal with cap movements? How are you going to evaluate alternative indexed options outside of just 1 year point to point? And then when we see different cycles in the interest rate occur, when is the right time to go out and hedge? So when are you going to go fix? When are you going to collar? When are you going to cap? And then what kind of payments are you going to make depending on that cycle? And so for a firm like ours, who operates independently, where we do some end client business, work through advisors, work through institutions, the ultimate value add is we're taking what we would deliver to an end client and trying to make it available to the market. And we have a team of 17 people supporting the 3 producers in the firm. And if you go into a transaction, you just better be prepared to navigate what the environment's going to look like in 3, 4, or 5 years, because it's certainly not going to look like today. Could be better, could be worse. Well
said, right? So it goes back to, so again, where do the other assets on the balance sheet sit? And a fairly simple concept of simple versus compound, right? If you are outlaying simple interest to the tune of 50 to 100% of the annual amount being asked, and your external assets, along with your policy values, are growing in a compound fashion, then yeah, time is on your side, right? You will outpace. Compound always beats simple all the time, every time. So even at inferior rates, if you were borrowing at 8 and earning 5% credits, in time, it could be a really long time, but in time, the 5% compound is going to win. Now, you can hurdle that much quicker if your external assets are compounding at 15, 16, 17, 20, 25, right? So there is there is math that supports this concept. And use your chat GPT models to just break down the simple versus compound, and it's mind-blowing. um, so Chuck, we're almost getting to you, but I'm gonna toss this back to Justin. Justin, where deals breaking down the most, and where have they broken down? Is it outdated modeling, advisor missteps, over promising policy performance in different engineered indexes? Like, what red flags do you look for?
Yeah, you started to kind of list off several of them, but the number one thing is expectation setting, and expectation setting comes from sitting down and again going through detail and understanding client's balance sheet, understanding product. Like, I think there are a couple of fundamentals that I firmly believe in. Number one, people should be attracted to own life insurance for the exact same reasons they're attracted to own real estate. It's tax. Those are the two most tax advantaged asset classes out there. This predicament of borrowing at the same crediting rate. I mean, if you go buy a multifamily asset today, you're going to borrow at a rate that's roughly the same or even potentially higher than your cap rate that you're buying at. And so the same economics apply in other asset classes. Now they've got different instruments. You've got cash flows. You've got you've got appreciation, but the same logic applies. And I think if you break it down in a formula that the client understands, whether that's again real estate or private equity, put it in there, make it germane to their environment. They understand the benefits of this. Think about, we constantly think about from an estate planning standpoint, pre-funding a future liability using insurance. And one of the biggest risks or threats that exists is an untimely demise of the insured, right? And what's the ripple effect on, what's the tax waterfall look like on that? So those are things that are, I think, absolutely instrumental in getting right. And so that speaks back to what's happening that's wrong, which is, hey, here's financing, right? Here's premium finance as a strategy. And I hear advisors marketing, you need to do premium financing. Again, I'll use my real estate metaphor. That's like walking around finding people who are wealthy and say, you need a mortgage. You really need a mortgage, right? And I believe that the right life insurance product for whomever the individual is, given their situation, is as absolutely elemental as location is to real estate. You can buy a piece of real estate. Somebody can walk in and say, hey, I've got something that's a cap rate of 10. You're going to borrow at 5, and you're going to have this arbitrage, and it's great. Well, why is the cap rate at 5? Because you're taking extraordinary risk because of a location or because of some other situation with the building or permitting or whatever it may be, right? Same thing's true of life insurance, is that not every policy is built the same way. And so marketing what sizzles, marketing what illustrates best, marketing things with bonus features that you can't understand or can't articulate or understand when they might credit, how they might credit, or that the fact that you might have this unknown bonus that credits in an amount equal to or perhaps greater than the actual crediting in a policy. That's kind of a definition of insanity in our minds. It lacks any predictability. It lacks the ability to explain it. But it sizzles and pops. So if you sell what sizzles and pops, I think you have the potential to create, a firestorm of problems. So that's the number one thing. By the way, that's also the same thing that's breaking down existing policy structures, is clients realizing what they have. So lack of expectation setting on the front end that's appropriate. Clients, who they look at a spreadsheet that lasts for 50 years. They assume that the lender is lending them money for 50 years. Very seldom do we see something that shows like you're going to refinance this in 5 years. Terms might adjust. Your ability to accrue interest, some part or all, may adjust. I think anything that has any negative amortization aspect of it is, has the potential to be a ticking time bomb. So those are elements that I think folks get wrong. And again, I think it all comes back to, as Chris has so eloquently said here, that an advisor can have a great career with financing despite any economic environment that might persist for a moment or persist for a decade, if they build it right with the right clients and the right education.
Yeah, I mean, from our experience as a BGA and reviewing dozens upon dozens of finance deals a year, it's so often a producer will come to us and say, the client had a $50,000 spend, on budget in a given year, and the producer upsold to a permanent solution whereby they borrow $1 million at 5% and deploy that same 50,000, right? So you're buying permanent for a term budget, absent of doing all of the analytics that the two of you gentlemen have spoken about, balance sheet, right? Where's the exit? Does it make sense? And it was this blind approach. And once interest rates moved against us, right now that $15,000 spend is 200 or 150, right? And they don't have the means to pledge appropriate collateral, and you're unwinding things, and you have debt forgiveness issues, and it just becomes really, really, really messy. So Chris, I'll flip this back to you, and then we're gonna move to Chuck a bit. When you catch these types of issues early, right? These outdated models or advisor missteps or too much pressure on policy performance, is there usually a path forward, or are most of these deals too far gone?
So definitely situational, Anthony. As we talk about what can go wrong in a transaction, I think we also have to remember that one of the responsibilities of the client is the ability to maintain the financials to be able to support the financing. And, some deals that we've seen either within our book or in the industry that have not worked out has not been solely based on how the policies performed and where interest rates have gone. It could be this client had 70% of his net worth concentrated into commercial real estate, and he was worth 90. Now he's worth 30 and there's no liquidity. So I wanted to mention that because this is not all just isolated to the spreadsheet. There's many factors that go into onboarding and then managing these strategies. More specific to your question, depending on the point in time that they're in, they have a couple options. So oftentimes where we see stress from clients is they're not getting clear direction on what's happening, what the pro forma looks like, and what they can expect over the next 5 to 10 years. They're maybe getting an interest invoice and a collateral call without any real reset as to how the strategy could work under different variables or different cash commitments, or maybe putting dollars towards premium. I think first, making sure a client really truly understands what they have and what this looks like in different environments going. The next would be if something's changed on their balance sheet or with their appetite on lending with where rates are at today. We've had clients pivot out of premium finance, write a check, and either keep the contract that they have or maybe move it into something that is either smaller or less tied to the markets and just keep their coverage. And so they've realized a lower long-term benefit, but they've cut their risk exposure and paid some money.
Mm-hmm.
We also have to measure everything that we do against what their alternatives were. So if a client went into a transaction 6 years ago and they were going to pay 350,000 out of pocket, they're paying 200,000, let's say, in the financing strategy. You have to account for the fact that they've saved 150 grand for 5 years. So while collateral might be higher, or interest payments may be higher, we have to reconcile that against the alternative. And then the final two kind of ways out are you walk, right? You get out of it, cut your losses, so to speak, deal with any tax impact that you have, and then go out and reacquire, rebuy the insurance in likely a different manner. Or what we're starting to see a little activity is in the settlement market. So we've seen some clients of ours execute on transactions. They've had a change of health, change in balance sheet, and they're of a certain age. While this was never on their radar 15 years ago when they went to a deal, circumstances have changed, and that's a lever that we've had some clients pull to sell in a particular client case, one of their 3 policies, take the proceeds, true up the collateral, and maintain the other 2. So I think it just comes down to there's only so many options available, and they got to know on an annual basis as they look out over the next couple of years, what's it going to cost me to stay in this, and how is that working versus the original plan? What does this look like versus what I did what I could have done at the beginning without financing? So we got to measure it against something. And then the 2 options that we don't want clients to be in, but are the last resorts, are either settle or surrender. Which is I mean, that's we count on one hand the deals that we've seen that occur on, but that's got to be a conversation.
Yeah. So depending on the resources, these deals are fixable.
For sure.
Justin, I know how technical you are and how closely you study product, and I'm gonna cater to the audience here in an area that I don't usually like to go, but 60 seconds or less. So just so we don't dominate the rest of the 17 minutes or so we have left, and we want to hear from Chuck in a moment. Where do you like to utilize IUL? Where do you like to utilize whole life? And then where do you like to utilize the riders available to you, such as term blending or enhanced cash value rider or face reductions?
Yeah, okay, 60 seconds or less, speed round here. So, number one, it's the client's appetite for risk is going to be a big driver of that. I think horizon is going to be a big driver of that. Age, clearly a driver. But I don't think, I glean from Chris's comment, and certainly how I feel, is that it's not an or situation, right? I mean, it's an and situation. Bobby Samuelson put it great, I don't know, 10 plus years ago, saying the best policy for any client is probably a combination of product types, right? Some terms, some guaranteed, some VUL, some IUL, some current assumption, right? So we very much look at it as an and. It's both have a place. I think we're maybe a little bit more weighted into the whole life arena than Chris's comments, but it's close. I mean, whereas he said 70-30, we're probably 65-35-ish in our total portfolio. Both make sense. Both have completely justified with being on the platform. For a client that wants to take a lot less risk, the ability to point to get guaranteed cash values is pretty meaningful, and supports a rollout in future years under bad set of circumstances. And you want to make certain that like there's something like that's a graceful rollout in year whatever, or there's the Dukes of Hazzard rollout of the car before it goes off the cliff kind of scenario, right? We want to avoid the latter. So these products can be very complementary. We like to use both, like at young ages. Whole life becomes much more difficult to use as you age up from a standpoint of like a death benefit trough. But there are, again, designs that come that combine both products that are really complementary of each other and satisfy that death benefit trough and what have you. So again, I think both have a place.
Well said. All right, Chuck. So I'm going to just kind of set the table here for a second. Sometimes, right? Sometimes when you are completing your due diligence, you will find that the most efficient access to capital can come directly from your existing policy. Depending on the contract terms, depending on the interest rate environment we're in. So Chuck, describe the platform that Prudential has built and how you are seeing demand flow into that platform.
Yeah, I think I was just here to have the best hair on the panel based on my contributions to this point, but I appreciate some time. So as a carrier here, and particularly at Pru, we're in an interesting spot. We are active on the front end of these cases, right? People may not think of Prudential as a carrier here, and we've sort of been willing to do it for a while and not had the product that would support it. Now we're both willing to do it with a product that can support it. So we're certainly seeing cases that come in on the front end, and the cases we're seeing, I think, align pretty well with the values that Chris and Justin have said to this point, and that I know you have, Anthony. And then, my particular role in some of these has been on the other end. Is if any of you have ever heard me speak anywhere, what I probably talked about was something to do with helping policies with policy loans, right? It's kind of been my area of expertise at Pru here for a long time now. And we've really long since done a lot of that business, of sort of your traditional 1035s with policy loans, right? That's nothing new for us. The new part is when over the past couple of years, people really started coming to us with these premium finance deals to review, because it probably didn't make a ton of sense to borrow from your policy and repay the bank when the bank was charging you 2%. Right, it was very compelling, obviously, right? The industry saw a ton of it. And when the cases started coming to us is kind of what Chris and Justin were saying about when all of this stuff goes wrong, right? So why does a case come to us? It's probably not because the person who sold it is doing all of their due diligence and is updating the client, and the client thoroughly understands what's going on. It's probably because something happened that they don't understand, and they're getting asked for more money, and they're getting asked to post more collateral. And, oftentimes they've sort of long since not talked to that advisor. And, it becomes a challenge of how to manage this, right? And it's tough because, if I could talk to Chris or Justin 7 years into the case they started, they know what expectation they set. They know how we got there. They know what the goal was. I don't always have that, right? And if you look at it just based on the numbers, what you really have is unhappy client getting asked for money they weren't expecting, and where do we go from here? So the important thing to remember, I think, with all of these cases is that there was usually a point in time that they were going to pay the bank back, right? Very rarely, and I think Chris and Justin would agree, are they ever intending to never pay the bank back, right? So exiting the arrangement was part of the plan. So for some of the cases that we get, it's just time to do that, right? And then it's like any other policy review, right? Are you going to take a loan from your policy to repay them, the bank? And then is there a 1035 opportunity to a policy that will make more sense, right? That is our bread and butter. We have done thousands of 1035s with loans over the past couple of years. We can really look at just about any case on just about any product. For a lot of them, they can make sense, right? Particularly in a world where a 10, 15-year-old product, the caps may have come down, or the dividend raking, or whatever it is, right? The other side of them, and Anthony, oddly enough, you kind of started me down this path with a case a couple of years ago. We looked at one, and I told you it probably made more sense to just pay the tax and start over based on what you had told me they were looking to do. And I don't think you didn't believe me, but you set out on a quest to prove it and made this incredible spreadsheet, right? And ultimately agreed with my assumption, and that's really where we've seen some other cases go, right? We've seen a bunch of cases where it did make sense to just start over, and if they did want the insurance, just buy the new coverage. And that has, of course, we're going to be a player for those cases. So it's really a little bit of everything. The toughest part of it is just coming in after the fact and trying to unwind it because somebody didn't set the right expectation. And usually what prompted all of this for us is somebody that started out as unhappy, whatever just happened. And it puts us in puts us on the back foot initially. But the nice part is if you're in that position, that probably means you didn't sell the case, right? So at least they're not angry at you, and you have an opportunity to overcome it. I think we'd all probably agree it's better to just do the right thing on an ongoing basis and do the proper due diligence along the way. But there's a lot of this that has been sold with less diligence than
Yeah.
the two guys have expressed.
Yeah, Chuck, well said. And there's no coincidence that you're on the call and a really valuable partner to us at Prudential, in that your tentacles are virtually in every aspect of the planning, right? You can lead with initiating a finance deal with your IUL, particularly your new IUL product. You can accept 1035s from other companies, book them on your balance sheet, and provide clients more favorable terms, right? So you can use in totality or in conjunction with certainly refinance or reimagine of existing finance plans. And you're also extremely good with a certain product design that caters more towards older clients, right? And we have talked about the difficulty in financing older clients, whereby you can underfund, or you will allow the flexibility to underfund premium designs, retain capital, redeploy, right, your balance sheet, or leave the balance sheet intact, and then address premium increases at some point in the future, which is virtually the same concept as premium finance, right? It just kind of created your own internal arbitrage through flexibility in funding. So Pru plays a really important role in all aspects of planning. So as we approach the top of the hour here, and gentlemen, this has been incredible. Let's do a quick round robin, and let's talk about, what does a responsible exit strategy look like when a deal no longer serves the client? What is doomsday? Chris, you touched on briefly life settlement, surrender. Justin, any thoughts around this subject?
Yeah, unfortunately, we've had to face this more and more, and have had some, it's in some moments kind of a real troubling exercise. I think we want to step in and help, but when you're in the last few months, the example, maybe the worst thing I've ever heard in my career, and it happened relative to a finance structure that never should have been implemented, and that is now going to cost someone about 30% of their net worth to get out of it. And I told him that as time goes on, this is going to get bad. Policy might lapse, and you might be facing some really dark thoughts. Things like, Justin, I've already had them. I've thought that the best exit for this for the last year, my wife doesn't even know I'm in it, and the best exit would be for me to kill myself. Like, that's the wildest thing I've ever had said to me in a meeting, face to face. And so yes, I mean, there are some disastrous things that happen here, and these situations can really be the tail that wags someone's financial dog when not done right. No one wants to be a part of those conversations. Worst case scenarios are we kind of go through this matrix. Seldom does it make sense to pivot and do a 1035 into some new product that's supposed to do what the old product was meant to do. That's number one. Sometimes it can happen. Second piece to that is that solutions like Chuck went through where you do have a favorable result, whether in the policy financed or with doing an exchange to kind of like slowly rescue yourself out of it. Those are possibilities. In this environment, certainly there are situations where borrowing from the policy is less costly than borrowing from a third-party lender and or from yourself in that scenario. So that can make sense. And then you get into the potential for life settlements, which is it's a pretty narrow opportunity for a certain narrow set of ages and underwriting circumstances. And then unfortunately there's a growing population of litigators that has become educated on IUL and finance life insurance, and that's something that some folks are pursuing as well. So the best formula is making certain that you design these in the right way in the front end. Don't create these situations. But right now, in terms of rescue, sometimes I wonder if we're more in a recovery effort than a rescue effort. So pretty narrow set of options, but again, for those folks who need the death benefit, want the death benefit, bought it for the death benefit, there are paths out, but there's a cost.
Yeah.
Chuck, go ahead, Chris.
No, Anthony, I would say quickly, I think it's important for everybody to recognize that in their markets, there's been really good deals done. There's been bad deals done, and I think everything in between. I think the opportunity for everybody on here is that there is consistency in clients looking at this transaction. Big institutions have woken up to this. So, talking to your local RIAs, family offices, there's awareness happening within the transaction. You want to set yourself up to be a partner that can participate. I think if you are bringing in a firm like Justin's or mine, don't position us as the vendor, the intermediary, the premium finance expert. I think about it as, for your business, you have a core focus. This is now a large case, complex balance sheet, complex structure. You're bringing in a partner to help figure out how to pay for it. And whether that's funded out of pocket, split dollar, premium finance, I think Justin and I can kind of soften that conversation and let that client know that you're covering all the options. And then if they do financing to the litigation point, make sure you're covering yourself, crossing your T's, dotting your I's. You've got a firm package. They've seen different options, and you're not going to be apologizing in a couple of years.
Well said.
Yeah, and Anthony, I hope you don't mind me just kind of putting an exclamation point on that. I think that the smartest financing transactions that will get done in the balance of this year, probably into 2026, may not be financed. And what I mean by that is that with the right set of team members and the right approach, like Chris talked about, what I would kind of refer to as the law firm model, is that built today to be financed at any point in the future, and with a management plan that goes along with that constantly takes that policy or set of policies, that portfolio, through a decision matrix that's defined on the front end yet dynamic. That is a powerful solution. So just going in and selling a policy, you might be selling something that is just not right for financing in year 4, but the client's going to want it, right? So having a team that can help you build the right portfolio based on cash flows and then keep that dynamic decision making in place is path to success.
Terrific point, right? And going back to Chuck and the flexibility in some of their products, and term blending at New York Life and some other different carriers, you can crawl into these policies without financing, right? And these policies are with term riders or IUL. They do present flexibility options, right, to increase premiums later on in a better interest rate environment. So yeah, looking at these deals holistically, if you don't finance today, it doesn't mean you won't finance tomorrow, and vice versa, right? So looking at this with a professional is really the ultimate outcome. So Chuck, finish this sentence for me. The best premium finance deal in 2025 will be the ones that
are done with experienced people, right? I mean, the stuff that that we see that hasn't gone well is usually the stuff that is not done by people who regularly do this and don't know how to keep up with it.
Chris, the best premium finance deals 2025 will be the ones that what?
The ones where the clients can afford to pay the premium.
Well said. Justin, how do you finish that sentence?
The people are buying it because they need the life insurance.
Well said. Well said. All right. Thanks again to Justin, Chris, and Chuck for bringing the clarity and the candor to this subject. Thank you to our audience for being with us today. If you would like some help evaluating a case or speaking to one of these experts, modeling a new strategy, or just want to dive deeper into something we may have covered, please don't hesitate to reach out to me or your brokerage director at Life Brokerage. I want to thank our panelists here, Chuck, Chris, and Justin. Amazing job, as always. And I want to wish everyone a terrific afternoon here on the East Coast and a great morning for the rest of the country. And let's keep leading with clarity and purpose and keep driving deals home. So thanks everyone for joining. Be well.
Thank you.
Thanks, Anthony.